Hello Proponomics people, and welcome to my video from Wednesday the 13th of March 2024. And today I'm going to be mostly talking about the recent release, the ONS report from this morning about monthly GDP growth. So as I'm sure you'll know, the UK has been in a technical recession for 6 months. So that's the shortest recession you can have, because it has to be 2 quarters of consecutive negative growth. And we had a minus 0.1 followed by a minus 0.3 in Q3 and Q4 of 2023. Now, Q1 of any year is normally notoriously difficult to achieve growth in. The UK economy has been relatively sluggish in this quarter over the recent years. And of course, we only have an economy where the top brass at the moment really believe our growth rate, our organic growth rate, is about 1 2/3% every year. So 1.67%, not exactly that inspiring, but growth is better than contraction, of course. So monthly figures out this morning, 0.2% up for January. So that's how it is. We run about 6 weeks behind on these figures. And of course, 0.2% up is better than going down ultimately, but not necessarily a turbocharged start that really would have made us absolutely convinced that Q1 2024 is going to print a positive number. And if you actually look at the monthlies over the past 9 months or so, it has followed a pattern of up, down, up, down, up, down. They've had a few months where it was really quite flat. December was minus 0.1, so January plus 0.2 has obviously got that back, and is hopefully the sign that we are returning to growth. As I've said, I'm sort of 85-90% convinced that we are returning to growth, and the whole recession thing has been, it's just a dictionary definition. It's not really helpful. It's not necessarily anything anybody's noticed. In fact, I think if people are honest, they would tell you that actually the hardest times were 2022 and early 2023, when cost of living was really at its height, energy prices, all the concern, all the stress, all the rest of the stuff that came along with that for the average household. So largely good news, though, of course, mostly contributed to by services output moving up 0.2%. As you'll know, services, massive part of the UK economy. That's why it's a 47% component of the inflation figure, CPI, is the services inflation figure. And that seems to be going along well. And that's congruent with the PMIs that I talk about, the purchasing managers indices. We see those much more in real time, and they've been fairly expansionary. And also we had construction output growing at 1.1% for January, which is great, but new year, new start and all the rest of it. But the 3 month is still down 0.9. So construction sector still just struggling to come back, and production output down 0.2 month on month. So manufacturing, obviously a much smaller part of the economy these days than the services side of things, but comparatively good news. And as I say, better than it going downwards. So yeah, construction fell in December by 0.5%. So that 1.1 is good stuff. And of course, construction normally you'd expect to slow down a bit. A lot of things delayed from December going forward in January. So perhaps not a big surprise. What were breaking down the services a little bit further, education was the largest negative contributor to the services side of things, falling by 1.7%. Quite a significant fall, really. That's over the 3 month period. So that's November, December, January of 24, of course. 6 of the 14 subsectors of services actually shrank in this quarter. So where did we do really well? Repair of motor vehicles and motorcycles, strangely enough, was the largest growth area month on month, and that was a change from it going down a bit over the 3 month period. I guess you would expect as well, with cost of living being what it is, then you'd expect there to be more repairs to cars and fewer new cars, fewer new lease cars. Of course, the price of cars has gone up because of inflation, apart from anything else. But of course, the monthly payments have also gone up significantly, because we're not in a world where we're getting really cheap financing on cars anymore, because the base cost of that money is starting off at about 4%. So they were enjoying massive margins, although you might know that the leasing companies, some of them are in some trouble, the financing companies, because of loading some extra insurance onto things. Sounds a little bit like PPI to me in many ways, and the industry is in a bit of flux at the moment around all of that, so not necessarily going to be easy. So yeah, education, the biggest 3 monthly negative contributor by some way. And then also real estate activities, which is the one subsector I always look at closely, of course. very, very flat indeed. Nearly no month-on-month movement, nearly no 3-month-on-3-month movement. Again, we'd expect that to change as we go forward, because remember, we're talking about January's figures, and we know that we saw things get a little bit better in the marketplace. I'm kind of surprised January was down so much, but of course, this is what sales agents don't put the money in the bank in January for transactions that they agree in January, and not too many charge much money up front. Some make small marketing charges and things like that, but nothing that would necessarily make a huge difference, really. Consumer facing services grew quite significantly, 0.6%, and again they'd fallen in December. Retail trade had done quite well, as you might remember from January's retail figures were significantly up, but December's figures had been down so very much. I did actually question the integrity of the figures, because it does seem strange for them to go down so much before Christmas and then pick up so much after Christmas, but that's how it happened. And of course, remember, some of that is year on year, so it may well be that Christmas 2022, people had that Christmas they felt they'd been cheated out of in December 21 and December 20, when they were really, really, damp squib Christmases apart from anything else. So just a little bit more on construction. Over the 3 months to October 23, new work down 4.5%, which is really significant. But repair and maintenance up 4%. So that's explaining a bit of the 0.9% fall over the 3 months, because there had been 3 falls in a row in construction output. So January has sort of snapped that off, which is useful. But we've definitely seen a relative almost construction recession, really, I suppose is a way of looking at it. And hopefully that's been snapped off. Things have been relatively flat for some time. Hasn't really moved on an awful lot since 2019. The index now, all work, is 104.7, and that's based on it being 100 in January 2019. So imagine a 4.7% increase in the entire sector in 5 years and 2 months, so 62 months. So really, really limping along, really, the construction sector, which I think everyone would know, and difficult to see, of course, where all the new houses that are being promised by the probably incoming Labour government are coming from, as everybody will know. But that's ultimately where we are from a construction perspective. And then there is also the fact that we will be seeing, so next figures will be out in second week of April, and that will be for February. So we won't actually technically know about whether this recession is over until second week in May's figures come out, ultimately, which is a bit crazy, but that's where it is. That's how long we've got to wait for. Now, of course, as I say, we've seen the flash numbers. We're not far away from the next flash PMIs for services and the likes. We'll see those, the first ones on Thursday this week, which is super. Sorry, Thursday next week. They'll be not Thursday this week. And if we're staying in the sort of 53 plus segment that we've been in for services, then you can pretty much guarantee then that will take us to 99% certain that the UK economy is out of its little slump. Of course, you never really know until it's over, in case anything incredibly crazy happens before the end of the month. But that doesn't look likely at the moment. We've only got sort of 2.5 weeks to go, so we should be okay. So hopefully this sort of longer breakdown of the GDP figures is interesting and worthwhile, and you can see why I go into these things in detail. It's important to know what's going on in terms of new construction. It's also important to know what's going on in terms of repairs and maintenance. It gives you a good idea of a bellwether for the market. Of course, the market takes time, because when developers have been sitting on land banks, for example, it's not just click a button and then suddenly we've delivered a site. They've got to go out, they've got to bring people back in order, got to get the subbies in to do the work, they've got to crack on with delivering sites and selling them and getting the money in the bank, which is not a quick process. So what we're seeing at the moment, and what we always see, is really based on decisions that were made between 12 and 24 months ago, maybe even longer than that, really, the time horizon. And it probably therefore doesn't surprise you we're only up 4.7% as a construction sector from 5 years, 2 months ago, because ultimately that's where you might expect us to be for decisions that were being made in early 2022, where it might have looked a bit trappy. We'd started to raise interest rates in December 21. We know that lots and lots of big companies, the CFOs, started to fix their debt because they knew the rate was going up. So it might have been around the time when they just started to be cautious about delivering too many units and instead preferred to deliver fewer units and control the price. Thanks.